Hi guys, I'm Phil Town from Rule 1 Investing. Today, I'm going to tell you about a metric, a little signal that might predict if we're heading for a recession. If you've been paying any attention to the market recently, you're probably wondering if a major crash is going to happen sometime soon. And I completely understand, because I completely anticipate a pretty significant market crash pretty soon myself. We're in a record long bull run on the market. Never in the last 140 years of investing have we seen anything like this. We expect to have a recession and a stock market crash typically every 5 to 7 years. And we're entering into our 10th year now. It almost happened in 2018, right at the end, but it didn't. Markets rebounded right now, but it could easily happen in 2019 or 2020. It is coming. I don't think we have gotten completely rid of the market gravity yet. In fact, one of the major indicators of a market crash could easily be the inverted yield curve, which occurred at the beginning of December. Now let's talk about what the inverted yield curve is, what it means for the future of the economy, and how you as an investor can actually, go make money. Take advantage of the opportunities that arise from this scenario once this market crumbles. So what's an inverted yield curve and why would it matter? An inverted yield curve occurs when the 5-year treasury bond or treasury bill, right, a government bond, when the 5-year trades below that of the 2-year. In other words, each of these bonds has some kind of rate of return for the end user called a yield. And when the 5-year, the longer yield, right, the longer you give somebody the money, the more you should get for it traditionally, right? In other words, I should be able to lend my money long at a higher rate of return than if I lend my money short. It kind of makes sense. But when the yield curve inverts, the opposite thing happens. The long-term lenders are taking a lower interest rate than the short-term lenders. Now the reason for this inverted yield curve is pretty complicated. I'm not sure anybody really understands, right? It just happens that the market decides to price things like that when people are lending money. So one reason for this can be that the Federal Reserve is tightening up monetary policy, which has been historically loose for the last decade. Interest rates, which have been artificially pushed down, are now starting to rise. And we saw what happened in the stock market when the Federal Reserve raised interest rates back in November. Boom, the stock market crashed. Now this tends to restrict credit, right? In other words, as they start to increase interest rates, then the people who are on the margin of being able to borrow at the old rate can't borrow at the new higher rate. The lenders won't lend them the money because they're marginal borrowers. So lending starts to slow down on the edges of the economy. Now, when you pair this with other economic conditions throughout the world, such as the ongoing beginnings of trade wars with China, slowing down of the European market, in fact, they just tried to stimulate their market starting today, and a slowing gross domestic product, which is our own revenue stream that we have here in the United States, the inverted yield curve is generally a harbinger of an economic slowdown and more frequently a total recession. It's been predicting them correctly for a long, long time. Now, if we're on track for a recession, it could take some time before it actually hits us. Nobody knows what's going to trigger it, right? It's like the straw on the camel's back. But it's unlikely that this next recession would be as severe as the Great Recession of 2008. That was a doozy requiring enormous government intervention, which we're just starting to deal with now. The usual timing delay between the inverted yield curve inverting and the onset of a recession is within about 18 months. So what this signal is saying is we could be well into 2020 before we actually start to see a major economic impact and a slowdown of the US economy. Now, regardless of when a recession or stock market crash might occur, I want to urge you guys, don't freak out, and here's why. You need to understand that investing is a long-term process. It takes a lot of patience and it takes a lot of practice. Just consider it a practice, like Danielle does, my daughter. Many people might panic because they don't truly know their investments, they don't really know what they own, and they don't really believe in the companies that they bought. And so they get freaked out when the market starts to crumble. The secret is to invest like a ruler, like the people who have been doing it right for the last 85 years. Rule 1 investors are confident in their investments. Why? Because we're in it for the long term. Patience is a core requirement for any successful investor. Otherwise, what's happening is you're setting yourself up to rely on emotion rather than strategic thinking. Now, preparing for a stock market crash is the greatest time to think about new investments because it's a fantastic time to buy after the crash. So you're going to keep a watch list of companies that you're interested in investing in, and you've completed your research. So by all means, take advantage of this time right now to really vet these companies based on your understanding of them. Are you connecting with them? Their competitive advantage, what's their moat? Do you really admire the people who are running this, and do you trust them? And what is the value of that business long term? And if you know the value, then you can figure out your margin of safety price. Now, once the price drops, right, as we start to hit a recession, once that price drops, you are going to be able to watch these prices come down of the wonderful businesses that are on your watch list. And then when they come down to the margin of safety price, that's when you begin to buy. This is really kind of fun. Remember, a temporary crash in the market, something that lasts a year or so, isn't going to put great companies under. It's not the problem. It's going to make these companies available on sale. And then we get to own them for the next 10 years, which is going to be awesome. Now, when you position yourself to be able to pull the trigger during the market correction, you're going to be in a great position by the time the market starts to recover. You will have bought wonderful businesses on sale. Now, the goal for us as rulers, as Rule 1 investors, is really simple, and it sounds kind of harsh, but here it comes. What we want to do is we want to buy when there's fear, and we want to sell when there's a lot of greed. And as you can see right now, there's more fear, more uncertainty in the marketplace that's going to continue to creep until it's really time to take action. And you're going to know when it's time to take action. It's going to be front page news about the stock market going down. What I want you to do now is perform your due diligence. This is an awesome time to make sure you're ready when the time comes. Now, I'd love to hear from you guys. What do you think about the inverted yield curve? Do you guys ever even know it was out there? Did you think it's a sign of what's to come? And leave a comment below with your answer, and I'll be sure to follow up with you. Now, thanks for watching, you guys, and go play. If you enjoyed this video and you feel it was valuable in teaching you more about the stock market crashes, hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. And thanks for watching.